Yeah. Okay, well, I think we can start. I would like to welcome President Bullard, President of St. Louis Fed and CEO of the bank. Our cooperation with President Bullard goes back a long time to at least 2010, when you spoke at our seminar that was held in the Parliament. And then we had dinner at Church House. So basically, we are greatly honored to have you today, and really, it's a privilege to hear you. Your leadership is been even more visible this year, and that has been marvelous. And what you say, your colleagues follow, basically. Obviously, it's been a very difficult time for every central bank in terms of policymaking, particularly since everyone has been used to a very low interest rate environment and low inflation environment. What I wanted to do is also welcome the participants. We would very much appreciate that when you want to ask a question, to turn your camera on. That would be really great if you could, and introduce yourself. So on that note, my name is Hannah Scobie. I'm the chairman of European Economics and Financial Center. When the Q&A starts, please raise your hand or send a message to the chat. I have a question. So on that note, over to you, President Bullard.
Well, thanks very much, and thanks for having me. I know you guys are all getting ready for the weekend, and probably for cooler parts, but I think we'll have a great discussion today. I always like these interactions. I'm hoping to get back to London soon in person, so I can see you all, and we can have a less virtual interaction at some point in the future. But I have been traveling. I was actually in Europe during recent weeks, including at the ECB forum. So we can talk a little bit about policy on the continent if you want later in this session. So I thought what I'd do is level set at the beginning here about how I'm thinking about the current situation for the US and the current situation for policy, and touch on a couple of issues, and then we'll open it up for discussion. Overall, I think the US economy continues to do very well, and in particular, US labor markets are very strong. And so let me stress that for a little bit at the beginning here. In the first 6 months of this year, the US has created about 2.7 million jobs. That would be an outstanding number even for a full year, but that's only for 6 months. So I think it shows that the US economy is continuing to have a very strong labor market. This is corroborated by anecdotal evidence I get from talking to people around the 8th district here in the middle of the country, but also across the entire country. So I think we've got a very strong labor market. We've got unemployment at 3.6%, which is just about at the pre-pandemic level. And I've also been more interested recently in the labor market conditions index that's put out by the Federal Reserve Bank of Kansas City. That's an aggregate of 24 different indicators of labor market performance. And it is well above the normal labor markets indicator, which would be 0 on that scale. and is in fact close to the levels that we observed in the late 1990s, which is widely considered the best labor market in the post-war era in the United States. So it's basically a great time to get a job in the US, great time to match up. It's a great time for workers that maybe have had trouble in the labor market to find a good match and a good wage and get to work. So I think I think this is the reality on the ground right now, and that's been continuing. I'm not really seeing very much in the way of abatement in this labor market situation, and so I continue to expect good reports through the second half of the year. Firms are saying that they're really scrambling to find workers. They're trying to adjust to the post-pandemic reality of that it's hard to get workers and that they have to be way more flexible. I think that the nature of the employment contract is changing because the flexibility component is changing so radically. So we can talk about that a little bit if people are interested. So now I think most of you would agree with those numbers on labor market performance, and we often take them hand in hand with GDP numbers. And I think many of you know that first quarter GDP in the US was growth was negative. And if you look at the Atlanta Fed's GDP tracker for the second quarter, it's also looking negative. And the rule of thumb would be if you had 2 negative quarters in a row, that would be a rule of thumb for recession. So there's some discussion among many of you that US is already in recession. Now, this is totally at odds with the labor market that I just described at the beginning, and particularly let's just say the Kansas City Fed's index of labor market performance, which is at a near an all-time high. So I think in this situation, we have to think about the GDP number as maybe not being the one that's the most accurate here. Now, in the US, you also have gross domestic income, and the gross domestic income is supposed to be the same as gross domestic product, but it isn't. And there's a statistical discrepancy between the two. And if you look at gross domestic income for the first quarter, it actually grew. And we'll see what we get for the second quarter, but you may get the same kind of disparity between GDP and GDI in the second quarter. But in this particular situation, for the first quarter in particular, where 1.6 million jobs were created, it seems like the GDI number is probably the one that you should go with when you're trying to assess total amount of income and product in the nation. And that was positive growth in the first quarter. We'll see what happens for the second quarter. There are special factors around that are going on with respect to inventories and with respect to the trade figures. And so, we could talk about that further, but I don't think, it certainly doesn't feel like on the ground that the US is in recession right now. Now, the other aspect of this is that markets have been predicting recession next year, possibly in the second half of next year, based on recession prediction models. I think those are fine as far as they go, but I don't think they're particularly accurate. And so I think there's, if I were you, I wouldn't want to be trading on, 100% reliability of one of those models. And I think you're all aware of that. So that's a more forward-looking statement about where the US economy will be 12 months from now. I'm a little skeptical that we'll get to recession. I think the US economy is slowing, but it's slowing to the trend pace of growth from a very rapid pace of growth that occurred in 2021. And I think that's the more likely baseline, is that after 5% plus real GDP growth in 2021, now you'll get something lower for 2022, and it'll be closer to the 2% trend pace for the US economy. So I think that's sort of my benchmark about where this is going. And, of course, we'll watch the data very carefully, as we always do. Now, let me turn to inflation. So the inflation report was again hot in the most recent numbers. Inflation has continued to surprise to the upside. It's continued to broaden out. I would say, a preliminary read is that based on these numbers and based on the household rent component, that core PC inflation probably hasn't peaked at this point. It probably has a few more reports to go, assuming all goes well, that it actually peaks and starts to turn down. So I think we've got a ways to go here still on inflation. And again, the committee, as of last year at this time, let's say between the June FOMC meeting of 2021 and the September meeting of 2021, would have been expecting about 2% or a little over 2% inflation for all of 2022. And that forecast has been blown out of the water, and now we're looking at much more inflation in 2022 than we would have expected sitting here 1 year ago. So we've responded to that by doing a lot and shifting U.S. policy dramatically in the last several months, and especially during the second quarter that just finished. We began raising the policy rate in March and made a 75 basis point move at the most recent meeting. We also started the balance sheet runoff quite a bit earlier, or maybe dramatically earlier than would have otherwise been expected. The pace of that runoff is about twice as fast as it was the last time around when we were doing balance sheet runoff. That should put upward, all else equal, that should put upward pressure on the longer end of the yield curve. And we've also promised considerably more rate hikes in the second half of 2022. And in particular, I would say my reaction to the hot inflation report would be to say that instead of trying to hit 3.5% by the end of this year, which has been my baseline for several months, I would now say that we may have to try to hit 3.75 to 4% by the end of 2022. Now, exactly when the committee would go about making those moves on the policy rate, I think is something that has to be managed by the chair. We could do more sooner, or we could spread that out over the remaining 4 meetings of this year. And exactly what the best strategy would be there, I would be anxious to hear from my colleagues where they're at. But I do think that inflation is proving to be broader and more persistent than we would have thought even 60 or 90 days ago. And therefore, we have to react by having a somewhat stronger anticipated path for the policy rate in the second half of 2022. Now, I've been an advocate of moving as quickly as we can to get to restrictive policy stance so that we're putting downward pressure on inflation. But thanks to market pricing, a lot of the pricing has already occurred, and a lot of rates have already been higher than their pre-pandemic levels across the Treasury yield curve. Of course, there's been a lot of fluctuation in recent trading sessions. But I do take some solace that the 5-year forward, TIPS-based inflation compensation, and the 5-year tips and swaps compensation has dropped down. I think that's a measure of confidence that we've got the right type of policy here to handle the inflation question in the U.S., and that the policy of moving expeditiously to neutral and into restrictive territory is the right one to try to quash inflation as soon as we can and not let this linger and become a 5-year or 10-year problem that we have to deal with. Let me talk for just a moment about
President Bullard, I'm sorry to interject. So we have a technical issue where only 100 people, the Zoom is at capacity. Would it be an issue if we were to resend out a new Zoom link that everyone could then rejoin?
Well,
this is going to be recorded. This is recorded and it's going to go on St. Louis Fed's website soon after the call. So it'd be very difficult to disrupt things.
Okay.
Okay.
I think a lot of people like to ask questions though.
Yeah, sure. We will allow that. But
Okay.
at the moment, it's difficult to send a new link.
All right. Understood.
Sorry, President Bullard.
Yeah, that's okay. So let me just talk for a moment about a few international considerations. So, as I said, I was in Europe for the Sintra meeting. I guess as a long-range observer, and all of you are dealing with this as well. We're seeing a more complicated situation for the ECB because of the fragmentation issue, but also, and probably more importantly, because of the war and the natural gas issue. And so they're trying to chart a path that does deal with inflation, but also deals with these other concerns. And so they're not able, I think, to move as quickly as the US. So as a US policymaker, that suggests to me that the onus will be more on the US to fight the global inflation problem and the dollar bloc countries that are also moving in tandem or even ahead of the FOMC, and that you'll get a stronger dollar especially against the euro and the yen, which is certainly happening, and that will have ramifications, let's say, for U.S. Multinational corporate profitability and other aspects. So I think that will be a important aspect. All else equal, the stronger dollar will mean less inflation in the US, more inflation in Europe than otherwise, but I leave it to you guys to tell me exactly how big those effects would be. So let me stop there. And there's many other issues we could touch on, but let me stop there and see if that has triggered any questions from this group. And I'm looking forward to talking to you all.
Thank you very much, President Bullard. That was an excellent overview of the state of US economy and all the policy issues. Unfortunately, our Zoom capacity has been 100, and we should have raised it because you're so popular, and especially at this time. But we're glad that it's going to go on your website. Let me begin by asking the first couple of questions, and then we will open up the discussion. And if you already have covered it, I'm sorry, because we get receiving lots of phone calls. You indicated that rates should go up to 3.5% by the end of the year. And in the light of the new reading of CPI 9.1 in June and non-farm payroll being 3.72, I was wondering if rates going to 3.5 at the end of the year seems still appropriate, or would you consider a higher rate? And also, do you think that going forward, would kind of intermittent rate hikes still be a possibility if the need arises, something that you mentioned last February. That's attracted a lot of attention at the time. You also talked about potential for future rate hikes if inflation moderates. I was wondering if at that kind of scenario, would quantitative tightening continue if you are likely to be cutting rates? So over to you.
Yeah, as I said in my opening comments, I think that I would now revise up the amount of policy rate moves I'd like to see in 2022. I previously had said that I'd like to see us at 3.5% by the end of the year. I'm now saying that I'd like to see us at 3.75 to 4% at the end of the year. And we do have 4 meetings, so there'd be a question of how to allocate those policy rate moves over the second half of 2022. But I'm leaving that difficult job up to the chair. And you know, the reason we have these meetings is to find out where everybody's at and how everybody on the committee has digested the incoming information and what we think as a group would be the best strategy going forward. So we'll see how that plays out. But I think from the market's point of view, you know, inflation has come in broader. U.S. inflation has come in broader and hotter than had previously been expected, even 60 or 90 days ago. And that suggests that the Fed, in order to get an appropriate policy to put downward pressure on inflation, has to react. And the way we can react is by charting out a course that's somewhat more aggressive over the second half of this year. And so I would support a strategy that would go in that direction. The question of, so let me just stress on sort of, you know, when to make these moves. I think we've benefited a lot from transparency. We've benefited a lot from being willing to react to data and move aggressively. And the market pricing has reflected a tighter policy ahead of the central bank actually making policy rate moves. So from that perspective, I think we have a lot more credibility than let's say the Volcker Fed would have had. And we get a lot more happening in markets much sooner than would have been the case in the 70s and 80s timeframe. And that's helping us a lot. And it's also helping, the transparency, I think, is also helping foreign central banks assess their own situations and make their own moves, sometimes in anticipation of Fed moves. So this is helping to get a more orderly movement to a policy that will put downward pressure on inflation. I think that's helpful. I know it's painful in financial markets to have to reprice tens of trillions of dollars of assets because the Fed is changing rates. But nevertheless, I think that this has probably gone about as well as could be expected so far. And you know, we're moving very rapidly, but because of the transparency and the credibility, I think we're keeping the total amount of disruption down compared to what it would be if we were surprising markets excessively. On
quantitative tightening.
QT, yeah, the QT. I think for now we've set that policy, and we, you know, I think we'd evaluate it at some point, but we'd have to get further along into 2023, and then we could evaluate at that time. I've said that, you know, we'd be willing to adjust policy once we're on a disinflationary path, and if it was clear that we were going to 2%, then we could possibly adjust policy at that point. But I think that's a discussion for the future. Right now, we have to get the inflation momentum turned around and headed back toward our 2% target.
Thank you very much, President Bullard. I now open the discussions. If you have any questions, please raise your hands or send a message. The first one goes to Paulo Gustavo. Can you turn your camera if possible, and also unmute yourself?
Hello. Yeah, that's me. This is Paulo speaking from JGP in Brazil. Thanks a lot, President Bullard, for the call. You've mentioned that the U.S. inflation has broadened and it's very hot, but at the same time, you mentioned that you expect the economy just to slow a bit and not go into recession. So I'm wondering if that will be enough to bring inflation back to the target in a reasonable horizon. And also if you could elaborate in your thoughts about the pros and cons of front loading the interest rate hike.
Yeah, on the idea that we can get a disinflation back to 2% inflation without going into recession, I would say this is not the Volcker era. The Volcker era didn't have an inflation target. No one had even uttered the words inflation targeting, I don't think. And Volcker had to fight, and his team had to fight for credibility at every juncture. They often made moves and got no reaction in financial markets, no change in market pricing. And so in order to get the disinflation, they ended up with a very chaotic and deep recession in 1980, 81, 82. It's actually counted as two different recessions, but it was all very connected and chaotic. I don't think in the modern era where you do have an inflation target, we have a congressional mandate to provide stable prices, and we're doing exactly what we need to do to get inflation to go back to 2%. We're doing it in as orderly a way as we can, given how far we have to move here. I think some of the disinflationary effects are already in the market. So I think the long and variable lags that Friedman would have emphasized, those are based on data from the 50s, 60s, 70s, 80s. And I think that was a different era as far as monetary policy. Here we can get much faster, I think, impacts on the economy through monetary policy because we're credible, because we're transparent, and because we get the market pricing much sooner. I think we have done that. And so I think inflation can come down relatively quickly to 2%. That doesn't mean next month, but over the next 18 months, I think inflation could go back to 2% if we play our cards right. And the market-based inflation compensation does seem to indicate that, at least for now, that markets are confident that this program will end up in a disinflation. Where did the inflation come from? We had a big reaction to the pandemic, outsized fiscal policy, accompanied by a super easy monetary policy. So sometimes when you would see a big fiscal program, the monetary authority might offset that somewhat. That didn't occur here because it was the pandemic. And of course, we were trying to do as much as we possibly could. So you had the big fiscal program without an offset from the central bank. And I think history will say that ended up being somewhat too big, and so we got some inflation out of it. But now that fiscal program is over, and we'll go back, it looks like, to divided government here in the U.S. Shortly, and the U.S. Federal Reserve is doing exactly what it should do. We're raising rates to combat the inflation problem, and we're emphasizing that we're intending to get inflation back to 2%. And so it seems to me that this is all very feasible, and that we can get a soft landing. I know that markets are betting against us, but that's still my best case. My base case is that we will be able to get a relatively soft landing and be able to disinflate in an appropriate way to make up for the fact that we overshot here on inflation by quite a bit.
Thank you, President Bullard. That's our
Thanks.
base case as well. We don't think there's going to be a hard landing. Until somebody else raises their hand, let me pose another question. Real yields have moved up sharply over the past month, and longer rate inflation expectations have moved lower. Can you give more granular insight on what progress looks like on getting inflation down?
So with respect to real yields?
And getting inflation down. I mean, we have our own scenario. We've done a lot of work on the causes of the price of oil moving up or down, and how it's manipulated by the oil market. And certainly you remember that price of oil went negative in April 2020. Equally, I mean, that was completely manipulated by 6 traders in the East End of London, and they were prosecuted in Chicago. And I will send you further details on that and some of the research we have done. And equally, on the other side, raising for the price of oil going up, there's been a lot of manipulation, and certainly Glencore has been fined 1.1 billion, and there's a lot of speculation and wrongdoing in the market. So the question is really, how do you actually see inflation getting down, in your view anyway?
Yeah, well, some of the people on this call might be interested in a deck I used. It was an academic talk called Disinflation, Reflections on the Methods of Poincaré and Thatcher. So a few of you may know what that refers to. There was a debate in the early 80s as the Volcker disinflation was getting started about how to do this. And some people said, well, you're going to have a big recession. Other people said that the disinflation could operate through inflation expectations. If you read the literature on the basic equation, the basic modern equation for determining inflation, it has some kind of unemployment gap term in it, and then it has some kind of inflation expectations term in it. And in many ways, the inflation expectations term is much more important than the gap term. So I think in normal times, when inflation is simply at 2% and the inflation expectations aren't moving around very much, then it's mostly the gap term that is causing small fluctuations in inflation from day to day or quarter to quarter. But in tumultuous times like here, where you've got way more inflation than in normal times, it's the inflation expectations component that's most critical. So what the literature said about this was that Volcker was not credible, so he had to have a big recession in order to get inflation down. But modern central banks are much more credible. We have inflation targets, we have legal mandates, and so on that say that we're supposed to get inflation to 2%, and in addition, we're taking the actions to do that. So this is about more about the credibility of the central bank, the reaction to data by showing that we're going to have a tighter policy in reaction to data, and getting the inflation expectations to return to something that's consistent with our inflation target. And if you look at the TIPS measures, they have moved down, and you could say we can debate a lot of things about those, but markets don't seem to be pricing in 8 or 10% inflation over the next 10 years. They're predicting that inflation is high today, but that it will come down in the future. So this all sounds very good to me from my point of view about how inflation expectations work, and that we'll have this bout of inflation. It is high today, and it's staying high, it's stubbornly high, but we've got the right policy to bring it back to 2% in a relatively short time frame, and I would say something like 18 months. And I think that that's probably the best we can do in this circumstance.
Thank you very much, President Bullard. The next question goes to Lukamek. Can you turn your camera?
Hi, President Bullard. Thank you very much for the call and excellent diagnosis. My question is about the impact of commodity prices decline and also strong dollar on headline inflation going forward. How do you see this impact playing out? And if it's true that headline inflation should decelerate because of that, but services inflation remains sticky, does that mean that we have, nominal wage growth is high, and if these volatile items in the CPI decelerate, would that mean an improvement in real wages and some like reverse of the relative price change that caused such a decline in real wages? Thank you.
So on commodity prices, generally speaking, they have come down. It's obviously a confusing time because you've got the war going on and many issues around there. This is affecting the real economy in Europe. It's possible Europe would go into recession here, and obviously the Germany in particular, but others are very worried about this right now. And you guys, many of you on this call know more about it than I do, but that would affect the US as well. The European economy is actually somewhat bigger than the US economy, and so it would matter if they go into recession. Now, I think also you've got Chinese GDP coming in today close to zero, and this is a contributing factor to the possibility of European recession. Whether they will alter their policy with respect to COVID, I don't know. It doesn't seem like it. And frankly, I'm not that sure exactly what their medium-term strategy is with respect to COVID. So we may get more volatility from China on this dimension. So that's also affecting the commodity price complex. They're a big consumer, and so there are many factors going on here. Now, for the U.S., we have the committee historically has tended to look through commodity price volatility and tried to focus on core PCE inflation, and that has, like I was saying earlier, may not have peaked yet based on the latest numbers. So we'll have to see how those come out, but running a little under, between 4.5% and 5% right now. That's still a ton of inflation compared to what we're used to, and I would see that as maybe the medium term. One way to handle the commodity issue is to try to look through that and look at some of these other measures of inflation. If you look at the Dallas Fed trim mean, it's at 4% inflation. So that would be the lowest one of the main indicators that we look at. It's not at all clear that that one has peaked either. We would like to get that to come back down to 2%. So, if you took the Dallas Fed trim mean as a benchmark, at least as of right now, we'd be looking to get rid of 200 basis points of inflation in the US in order to return that one to target. And then, I'm not sure what will happen with the war. A resolution to the war, even a bad resolution to the war, but any resolution to the war would also change the pricing dramatically. And so I think most everybody I talked to in Europe seemed to think that there wasn't much prospect of any resolution anytime soon of any kind, but you never know. So I think that's also something to keep in mind.
Thank you very much, President Bullard. You're quite right about no resolution to the war for the foreseeable future. The next question goes to Sean. Could you unmute yourself and turn on your camera? Thank you.
Hi, guys. Thanks for the call. President Bullard, I guess, the elephant in the room question here is you're saying 375 to 4 is your new kind of policy rate for the end of the year. So could you speak to the benefits of maybe front loading, 100 basis points at the next meeting? You're going to have more to do. We've been seeing other members push back against a larger move. Yeah, so I guess kind of your thoughts on whether it makes sense to move at 100 basis points in July now. Thanks.
Yeah, I mean, I've been an advocate of front loading, and the committee has done a lot here to move up the rate increases sooner. I mean, I've always felt like if you want to be somewhere with the policy rate, ideally you would just go to where you want to be, and then from there it would depend on data going up or down. But here, during this episode and during the second quarter here, we were starting from near zero because of the pandemic. And so I think we wanted to take it off in sort of bite-sized pieces and not try to do too much at once, although, it wasn't that long ago, the 75 basis points would have been considered, too much. But I do think that, it probably doesn't make too much difference to do 100 basis points here and less in the other 3 meetings of this year, or to do 75 basis points here and slightly more in the remaining 3 meetings of the year. So I think that's a judgment that the chair can make in conjunction with the other members of the committee, including me. But that's a judgment we'll have to make about what the best strategy is. We do want to emphasize, and the chair has done a great job of emphasizing, that our commitment to get to 2% inflation is unconditional. It is a matter of our mandate. We're doing very well on the labor side of our mandate. So it's really just a focus on returning inflation to 2% has become the #1 political issue in the US, and it's affecting all households, across the board. And so, exactly what the right tactics are, that'll be discussed at the meeting. But I would like to get to the 3.75 to 4% by the end of the year.
Thank you very much, President Bullard. The next question goes to Troy Davig. If you could unmute yourself, that's great.
Great, thanks. Hi, President Bullard. Thanks for your comments, very interesting. I'm wondering if you could just say something about your thoughts on survey-based inflation expectations. We saw large revisions in the Michigan numbers last month. That potentially seemed to be something of an impetus for the move last meeting. I'm also interested in your thoughts on the New York Fed, 1 year, 3 year ahead inflation expectations measures. And specifically, if you look at the distribution, you see the distribution has really blown out. You've actually got the 25th percentile at 0 and the 75th percentile at 8. And that suggests, the median might be pretty unstable. So anyway, my question is, survey-based measures of inflation expectations have really been moving. They look stable, but there's a lot of movement under the hood, and just your thoughts on those. So thanks.
Well, Troy, great to see you. I see you're still alive, so the gods must have a sense of humor.
I am. Thanks.
Okay, great questions on survey-based expectations. As many of you know, I'm not that big a fan of survey-based measures of expectations. I do look at them. I prefer to look at the market-based measures because I think they're more sensitive to day-to-day data, and so they're more useful for the kinds of things we're trying to do in the policy world. They have both types of inflation expectations have to be interpreted carefully, and I think that's an important reminder because sometimes you get wrapped up in the survey-based measures, especially the survey of professional forecasters. They have utmost confidence in the Federal Reserve, and so they always say that inflation is going to go back to 2% relatively quickly. Whereas households, the survey-based measures near term tend to just be reacting to the most recent price increases and other factors. I think sometimes factors that are distant from monetary policy, like the politics of the nation, or whether there's war or peace in the world, or other types of factors that maybe aren't as close to monetary policy as I'd like them to be. I have been concerned that the 1 year to 3 year inflation expectations in the surveys have bumped up dramatically. I don't take much solace from the survey-based side, where when they start looking at 5 to 10 years in the future, I think that's infinity from a household's point of view. So, the question is whether the 1 year to 3 year inflation expectations are going to start to change behavior at the household level. And it's inflation at the household level is, it's very noticeable. I mean, people really get hit hard, especially people that are in sort of ordinary salary jobs where they don't get a lot of adjustment in their wages. They really have to cut back dramatically, and this is very noticeable for them. So I am concerned about that dimension, but I do take some solace that the longer term tips and medium term tips have compensation and swaps have come down. So that's giving me some solace that we've got the right policy in place and the right amount of credibility in order to get on a disinflationary path going forward. On the question of the distribution of the survey-based inflation expectations 1 to 3 years ahead, I would direct everybody to Ricardo Reis, who has papers on this recently, very interesting, about the distributional aspects and how you're developing a tail out there that is expecting quite a lot of inflation for a long time. And that's worrisome because that sounds like the 1970s. So I would definitely want to be inspiring credibility on the part of the Fed so that we quash down those kinds of expectations and don't get an entrenched inflation situation in the US that we have to battle for 5 or 10 years. I think that would be extremely damaging to the US and to the world.
Thank you very much, President Bullard. The next question goes to Bernard Tamler. You could unmute yourself.
Thank you, Dr. Bullard, for the time. I actually have 2 questions. The first one, how do you feel about the financial conditions right now? Because we are seeing the credit markets really dry right now. High yield issuance is basically non-existent at the moment. Do you feel that this will trigger investment slowdown? And the second question would be, if we end up with the trade-off between a hard landing or keeping inflation in control, what would you choose? Thank you very much for the time, sir.
Yeah, thanks very much. So I think on the question of sort of market volatility in response to our policy, I think we are trying to be transparent and forthright in saying that it's time to raise interest rates to a restrictive level that will put downward pressure on inflation, and that's causing a lot of repricing globally of all kinds of assets. And so I've appreciated that repricing has to occur, and we're certainly seeing some types of assets a lot less valuable than they would have been in a lower interest rate environment that was expected to persist. To me, that's not surprising. I think more speculative bets where the profits are further out in the future, those have to get discounted now at a higher rate. That's going to make those kinds of bets less attractive. I think, fixed income itself, certainly once rates settle down, is going to look more attractive than it would have previously. And that's going to change all the pricing of everything in the entire universe of financial assets. So I think this is a process that means that there's a lot of volatility and there's a lot of question about just how far the Fed will have to go to get the disinflationary process going and completed. And so we'll see how this plays out. So I don't think any of us can actually know how this is going to go at this point. Now, on the question of whether if it was a hard landing or it was still high inflation, I think the committee at that point would have to make a judgment, because then you wouldn't have this one-sided aspect that we have right now, where we're doing very well on the labor side of our mandate, but very poorly on the inflation side of our mandate. If you had the big recession, then you wouldn't be in that situation. You'd have both sides of the mandate failing, and the committee would have to make a judgment about where to go on that. But I think getting inflation low and back to 2% expeditiously will be the best path for the medium term in the U.S. economy. One of the problems with the 1970s was not just that you're tolerating high inflation all the time, but that the real economy was also quite volatile. You had many recessions, some of them very sharp recessions. 1974, 75, again in 1980, again in 81, 82. And so you had not just that, inflation happened to be high, you had that the prices were not sending the right signals to investors and to households about true value. And so you didn't have the right decisions being made, and this messed up the entire economy. Once we got inflation under better control in the 1980s, we had a very long expansion. Again, in the 1990s, a very long expansion. So I think there are tremendous benefits to getting inflation low and stable, and that should feed into much better prospects for the real economy. And so we're shooting for that and hoping for that. And the other thing I would say about a hard landing is, we think rates are high. This group thinks rates are high now, and that they're going quite a bit higher. But those are not high rates compared to the historical context when you've had this much inflation. So I would also say that the 80s expansion had much higher rates than we have today, much higher real rates than we have today. So the economy can grow and prosper in a different rate environment. And I think that's been lost a little bit. We think that, if rates aren't zero or something, that that we can't grow. That's not true. The historical experience is very different from that. But we do want to get rid of the inflation, and we're going to have higher rates to do that.
Thank you very much, President Bullard. The next question goes to Nikhil from Tudor. Unmute yourself. Can you unmute yourself?
Thanks for the comments, Dr. Bullard. I hope you can hear me clearly.
Yeah.
Great. I was just curious how much attention you're paying to yield curve. Inversion is popping up at different parts of the curve. What's also interesting is the inversion is moving forward. And how do you reconcile the fact that the market's pricing in about 70 bips of cuts for next year? And we also are pricing one of the fastest turns, where we are going from hikes in the increments of, like, say, 75 to 100 bips, and then cuts, coming like in a 6-month time frame. So how do you read that data? What do you make of it? How are you paying attention to that?
Yeah. Okay. I'm going to give you a story about the yield curve inversion. I take that very seriously as a signal, and it has been accurate in the past. I do think this time is different. So I'm going to tell you my this time is different story. Here, what you have is a lot of inflation right now, but a Fed that's pursuing the correct policy to get rid of the inflation. And so we're not going to have this, if everything goes well, we won't have as much inflation 5 years from now as we have today. So that has to be priced in to the yield curve. And so that's just a pure nominal difference in the yield curve, given differing expectations over different horizons for inflation. So I think the reading of the yield curve inversion is different in this circumstance than it would be if inflation was just at 2% and expected to be at 2%, and then we got a yield curve inversion. Then I would take that as a more serious signal of future recession. But here we've got high inflation today, but knock on wood, low inflation tomorrow, and so that part has to be priced in and is being priced in because the Fed policy is pretty credible, and so I think we're getting some of the inversion coming from that part, which is not a recession indicator. So I think it has to be interpreted carefully, as always, and that's part of the story, I think, in this environment. And then you had a second part to your question.
Just in addition to, so absolutely fair point about the inversion further out, let's say 2 cents. But what about the 70 pips of cuts priced in for next year? Because inflation will come down as we see the path, but would it come down fast enough, or would at some point, the downturn narrative will overwhelm the inflation narrative?
Yeah. So I have fed this narrative a little bit. So when I've talked about this, I've talked about 1994 because I like 1994 as a sort of benchmark on how this can work and how you can get a soft landing. And just to remind everybody, the Greenspan Fed increased the policy rate 300 basis points in a year. From a higher level. They started at a higher level, and then in the second half of 1995, they made a few adjustments lower, and this set up the U.S. economy for a beautiful second half of the 1990s, one of the best periods for the U.S. economy for economic growth and for labor market performance. So that's a sort of benchmark. I understand inflation was not nearly as high in the mid 90s as it is today. But on the other hand, I don't think the Greenspan Fed had complete credibility that we have, as much credibility as we have today. And so, they were fighting a little bit to maintain credibility, build credibility, and get to the 2% inflation target, which hadn't been achieved even in the 80s and even in the first half of the 1990s. So the reason I like to tell this story is because once you get to a more realistic level of the funds rate that will put downward pressure on inflation and reinforce the 2% inflation target, once you get to that level, you can then make adjustments. And maybe those adjustments be up, maybe they be down. You're probably going to have to tweak based on incoming data and shocks that occur over that time horizon, because monetary policy never sits completely still. So I think the idea that we would go up forthrightly, get to the level 3.75 to 4% that I've been touting here, and then kind of look around during 2023 and see how things are progressing and make further adjustments. I just would like to stress that you can then make further adjustments based on the data at that point, up or down, because at that point you kind of be at the right level, or what we think anyway right now is the right level to get the disinflationary process going. So we could certainly react to data on the real side that was weaker if we thought that was appropriate for the disinflationary path that we're on.
Got it. Thanks. That's very helpful.
President Bullard, we are actually out of time, but would you mind if one more question is put to you, or whatever.
Okay, let's one more question. I do have to get to.
Okay. This is from Bernard Razin. Yeah.
Yes, hello. Please excuse the background. I'm out on vacation, but this call was too important to miss. I have one question regarding the labor market and your outlook that a soft landing can bring down inflation, which is the only point where I'm scratching my head a little bit, admittedly. Now, if you have seen the latest Atlanta Fed wage tracker that has jumped to 6.7%. And at the same time, unemployment is pretty low, and we're still producing payrolls of 350 per month, with most see about 250 about, let's say, the steady state rate where the unemployment stays stable. So I'm wondering how you can see that wage growth without like a recession or a significant increase in unemployment coming down. To bring inflation down as well, especially if some of the cost starts coming down so that disposable incomes actually start rising at this wage inflation. This is really one point where I'm not sure how basically positive growth, even if close to zero, can help inflation reduce.
Yeah, I think we're working with a very flat Phillips curve. And if you try to get disinflation with a flat Phillips curve, you would have to have a very large labor market disruption in order to get the amount of disinflation that we need here. I've already said it's at least on core inflation, it would be 250 to 300 basis points of disinflation to get back to the 2% target. If you try to do that based on current Phillips curve estimates, which are for a very flat curve, the labor markets would have to be very disturbed in order to get that to happen. That's not the channel that I'm relying on. There's another variable in the new Keynesian Phillips curve. It's inflation expectations. And that's the channel that I think will be more powerful in this circumstance, and that will get us the disinflation that we need. And I think there's some credibility around this because the big fiscal expansion that we had for the pandemic is coming to an end in the US, and the Fed is doing exactly what it needs to do to get inflation under control. So this should keep inflation expectations tamped down and get us back to our 2% inflation rate. Now, with respect to labor markets, I think that I'm not a big fan of the wage price spiral story, which I think is an outdated story from the 60s and 70s. I think any economy that has a lot of inflation, you would expect to see nominal wages and the general level of prices moving up in tandem. But that's a symptom of the high inflation. That's not the cause of the high inflation. So I think what will happen here is that firms will recognize that there isn't going to be as much inflation in the future as there was in the recent past, and because of that, they'll change their pricing behavior. Otherwise, they will lose market share if they continue to try to raise prices in an environment where they're not going up as rapidly. And fear of losing market share is very tangible, because usually when you lose market share as a business, you lose it permanently. And your rivals have beaten you out. They've been more productive than you. They're putting a better product on the table at a better price. And it takes years to earn that back. So I think the disinflationary process will come through the price setters more than the labor market. And I have one other comment about the labor market, that real wages are actually falling. So you would actually think, based on that firms would hire more people, and they're certainly talking about wanting more people at these prices. So I think that's something to consider here. And also I think an important factor for everybody to mull over the weekend is that the nature of the implicit contract is changing in the US for many workers, not all, but many workers, because there's way more flexibility than there once was about work from home, being a remote worker in various circumstances. And this is changing, in exchange for the greater flexibility, firms perhaps don't have to pay as much on pecuniary terms for the same level of productivity. So I think, that's a real factor that's changing the nature of the wage bargain, and I think is confusing our readings of where wages are going generally in the US. So I think that's an important thing to be considering. It's not just that this is an identical job to the one that existed pre-pandemic. It's a more flexible job than existed there. And then what would be the appropriate compensation given that additional flexibility that you're allowing to the worker? So that, I'm sure all of you have experienced that perhaps directly. And I think that's making the wage data a little bit harder to interpret than it otherwise would be.
Thank you very much.
Thank you very much.
President Bullard. This was an absolutely excellent session, and we really, really appreciate your kind support, and the answers were very clear and very to the point. We very much hope that you come to London at your earliest possible time, and our invitation is always open. And I would also like to thank our colleagues who helped organize this seminar, and also thank your staff for doing such an excellent job. Thank you, President Bullard, and have a
Great.
nice.
Thanks, everybody. Have a great weekend. Take care.
Thank you. Bye-bye.